long as people have jobs, what we've seen consistently is the retail community is buying every dip. We had a little dip this morning, it got bought.
Mm-hmm.
So unless something changes on the employment front, I believe that they're going to continue to buy the dip. And hedge funds and other institutional investors, they're still pretty underweight.
Yes.
So if the data just is fine, never mind roaring hot, but if the data is just fine and we just keep chugging along in the economy without massive trade disruptions or any sort of big change to the status quo, I think we're just going to keep grinding up. I kind of view this almost like a 1999 sort of environment where we had, major risk off, and then financial conditions were just way too easy. And so, now, I view it as we may melt up even.
Welcome to the Rose Show podcast. I'm here with Danny Dayan, Global Macro Volatility Portfolio Manager. He also has a great Substack called Macro Musings by Danny D. So how you doing today, Danny?
Doing great. Thanks for having me. It's, we interact so often on Twitter. I think we decided it was time to have a face-to-face conversation. So thanks for having me on.
Absolutely. Thanks for coming on and very excited to speak macro and markets with you. It's our first time meeting and hopefully the first of many. We'll be talking about investing, making money, and the economy, which affects all of us. I want to go into your overview and your lens of the economy, your point of view, and how you view where we're at in macro.
I think we're at a stable place. Coming into the year, growth was really, really strong. Trump inherited a pretty strong economy with full employment, 3% GDP for 2 years straight. Inflation obviously, stuck above target, but optimism for the Trump economy was actually really, really high from some areas that, were left behind the last couple of years. Small businesses, market, manufacturing businesses, they were very excited. Now, of course, it's been chaotic to start. In particular, the trade policy had a very rocky start to it. Obviously, Liberation Day was kind of a crescendo of that. It got very volatile in markets. And, the way I call it is, once we hit the constraints in the markets, letting Trump know, letting the administration know, you're pushing this too far. They went very aggressive with the tariffs on Liberation Day. He's backed off, and so the biggest driver of everything in both a negative fashion and now in the upswing has been the sort of uncertainty factor. Uncertainty was really, really high, policy uncertainty. And they've done a good job in what I call taking the temperature down on trade to the point where, the incremental news is mostly positive. It's about getting deals. It's about, not escalating. It's more de-escalating. So I think the economy is in, a fine place. There's risks to both sides of it, of course. Anytime you look at, such change in policies, it can have pretty large impacts. But all told, we had another solid payroll report last week. The report was really what I call eye of the storm, where the survey for a payroll report is May 12th, right? So for the last report, we were very much still stuck in the mud in terms of the policy, the trade policy and the uncertainty around it. And since then, it has, really moderated, that uncertainty. Markets have reflected that. So I believe that, we've gotten through the worst of it. And so while people will look at some of the intricacies of the labor market report we got on Friday and say, this is deteriorating, that's deteriorating. To me, my view is that we had a window of weakness and we've passed that window of weakness. And so I would expect the economy to do pretty well from here, but we have to make comparisons. It's significantly better than what we feared on April 2nd, but I don't believe it's a better economy than what we had on January 20th. And I think that differentiation confuses people because if you got bearish anytime after January 20th, you're like, did things really improve that much? It was so much better, right? And that would leave you bearish the markets. But we work in a rate of change perspective, and things have drastically improved since April 2nd. And so, I'm pretty constructive on the economy. The biggest risk that I see is inflation. And so far this month, it was pretty benign, surprisingly benign inflation reports this month of May. But I do think that's the big risk, going forward, other than maybe some geopolitical dynamics that are going on.
Wonderful. Thank you for that. In economics is always about the rate of change and everything's relative. You need to compare to certain time periods like you just did. So, in your opinion, we're not as good as January, and I think anything's better than Liberation Day. I mean, that was a big bottom right there, short-term bottom in the markets. So, when you say right now you think that we're better than April, do you believe that this summer, where right now we're in June, we could be coasting along with no major, hiccups. And the market is now, SPX is over 6,000 last I looked. And, we could be going on even higher. Does that look like it could possibly occur?
I think so. I mean, we could have a wobble here and there, but as long as people have jobs, what we've seen consistently is the retail community is buying every dip. We had a little dip this morning, it got bought.
Mm-hmm.
So unless something changes on the employment front where we have not slower job growth, but where we have job losses, a layoff cycle, I believe that they're going to continue to buy the dip. And hedge funds and other institutional investors, they're still pretty underweight.
Yeah.
So if the data just is fine, never mind roaring hot, but if the data is just fine and we just keep chugging along in the economy without massive trade disruptions or any sort of big change to the status quo, I think we're just going to keep grinding up. I kind of view this almost like a 1999 sort of environment where we had, major risk off, like in 1998. In that case, we had a Fed response. We had a Fed response last year. And, then financial conditions were just way too easy. Like it was an inappropriate Fed response at the time in 98 with hindsight. At the time, they were worried. And I think that, they overdid it with the rate cuts as well last year. And so, now, I view it as we may melt up even. So I think grind up is sort of base case, but melt up
Mm-hmm.
is, sort of another scenario I consider. Because again, I think financial conditions are very loose. If I look at the impulses, like you said, it's a rate of change economy. And if we look at the impulses, financial conditions are very, very loose. Equities have had a strong recovery, in this period, and the retail community was the ones who really benefited from it because they were aggressively buying. So that supports the wealth effect. The dollar, in my opinion, is the biggest story in the markets. And that weakening in the dollar is a huge loosening of financial conditions. Rates, even though we've had a few scares in the bond market, we're well below the highs in yields on the year. And so, I think financial conditions are very loose and stimulative. We have the tax cut bill, which is not, official yet, but what we've seen in the drafts and what passed in the House is more stimulative than we thought it would be, where they front load spending in the next 4 years and then they backload the spending cuts, which will probably never happen, knowing politicians, for the next president. They set that there. So it's a smaller impulse. It's not a huge impulse. It's not like the Biden stimulus packages, but it is still a positive impulse. And overall, I think like I said, I think the economy is fine. So from all of these areas, I think markets have some tailwind to them.
Very nice. We love hearing good news. It's always a positive. And, as you and I trade the markets and we watching the markets daily, we see that there has been a trend and it seems to be there. The bad news is sort of behind us a bit. I mean, there's obviously a lot of uncertainty And, we're going to have to talk about these tariffs. I know we've been talking about tariffs, and that, can cause some inflationary factors. And I want to get your thoughts on that. Do you think, first of all, these tariffs are more of a negotiation strategy by the administration? Do you think they will eventually be as high as they're sound like they could be? I believe they just extended the pause. And what are your thoughts on that? Do you think it's a one up or it could add to the inflationary story?
Coming into the year, the expectation was that it would be negotiations to get some onshoring and to get to better trade terms with partners. But the story has changed. And when they decided to have a minimum universal tariff of 10% that applies to the whole world,
Mm-hmm.
it no longer is about reciprocal and a race to get to zero, right? So, the prior expectation was if we charge Europe 2.5% on cars, but they charge us 10 on cars, we'll go to 10, but at some point cooler heads prevail and we both decide to go to zero. And if we both go to zero, that's very positive for real GDP. But now, with the 10% minimum, with some sectoral tariffs on things like steel and potentially cars and semiconductors and things of that nature, and then some additional tariffs that may be in place on China, like they'll have higher effective tariff rate. We have effectively done a permanent destruction of the supply side of the economy, right? So the tariff policy is effectively a negative supply shock, right? And typically in a negative supply shock, the best example would be oil. In an oil shock, oil spikes, that causes you and I to spend less on other things because we're spending more on oil because we cannot avoid it.
Mm-hmm.
And as that happens, you get demand destruction, right? I go out to restaurants less. My local restaurant doesn't, have, business to as much business as a result of it. These things cascade through the economy and you get demand destruction, which makes the impact on the supply side from the productivity standpoint, from a manufacturing standpoint, be transitory. However, in this case, applying a 10% universal minimum is effectively a permanent destruction of the supply side of the economy. And so when you think about what that does, the tariffs will reduce capacity of manufacturing in the economy. For a quasi-permanent basis, it could take years before we get enough onshoring to replace, the supply chains and move manufacturing into the country to then eventually avoid the tariffs. It may never happen. It may never happen that we get that onshoring. It reduces productivity of the manufacturing sector, obviously, by having a tariff barrier, a barrier to trade in there. And it also reduces competition, right? So if I was a manufacturer that is, competing with low-cost foreign producers in China or Vietnam or Mexico, I was always at a disadvantage if I try to put prices that are most economical for me, for my business. You have to compete on price. But by putting tariffs in place, you remove that competition, you've reduced competition, and that improves business pricing power. So I'm probably the only person on earth who thinks this is a more sticky, permanent change that will lift inflation up in a somewhat permanent basis. It'll have a somewhat negative impact on real GDP relative to the baseline without tariffs. And it's not, I don't like the term stagflation because people think of the 1970s version, but it is effectively anytime you say a little bit lower growth, a little bit higher inflation, somewhat stagflationary. The best example I can give you is actually Brexit. So Brexit was a negative supply shock, right? In terms of decoupling UK and Europe, immigration was a big reason for it, labor flows and things of that nature, and trade. That has had a permanent reduction in the investment rate of the economy. It's had a permanent jump in wages, and it's also had a permanent jump in inflation. All of these have been a shift up that has been sticky since. And so, and their economy is frankly less dynamic and less strong. So I view it as almost like a Brexit, in that, it's a destruction of the supply side, and it'll be very hard to get enough of a positive supply shock response to offset that. So to me, this is going to be sticky. And on top of it, you have other dynamics that are also factoring into the inflation outlook, even though they haven't shown up yet. Like we really have not seen the tariffs in the current inflation prints at all. No impact really at all. But we know they're coming. Consumers are saying, I buy this and it's this much more expensive than it used to be. Businesses in the surveys are saying, their input costs are rising rapidly, they're raising prices. Consumer inflation expectations are, look to me, unanchored. And so when you have that behavior, coupled with a quasi-permanent supply shock, it looks to me like people are a little bit too complacent about the inflation outlook. There's other things that have me concerned as well, on the inflation outlook. Is money supply has started rising pretty rapidly again. In April, it rose more than twice the level of nominal GDP. It rose 11% annualized in the month of April, driven by 17 billion in consumer credit. Just a massive month of consumer credit in the month of April. And if we get, lending has been pretty much non-existent for the last couple of years, under the after Silicon Valley Bank, lending essentially flatline. This rising again is the real concern about a second wave, because I think you said, you're a monetarist, I'm a monetarist as well. Monetary driven inflation recycles into the economy over and over again. And so if we're getting monetary inflation on top of a, somewhat permanent supply shock, it has me quite worried. And financial conditions are very, very loose. The dollar has, a pretty big impact on inflation as well. The dollar selling off as much as it has, call it 11% on a trade weighted basis year to date, that there's about a 20% pass through to prices. It just takes 12 to 18 months. It won't show up right away. But as the dollar weakens, something that you buy from Europe or another place just naturally goes up in price. It's pretty straightforward to understand that. So I think all of these factors point to inflation higher. And that's why, I think the market's obsession with rate cuts, which have been in place for 3 years, is misplaced. Even though there may be even some legitimate reasons to consider rate cuts, in that, the labor market is not printing as many jobs. Continuing claims have inched up, a little bit. Somewhat of a cover for the Fed to say, hey, we could cut rates. But I don't think it's appropriate. And I think if they do cut rates, I think we'll be in big trouble, down the line.
Great case you make there. Cutting rates and being overly aggressive, then they loosen even more. You could definitely cause that inflation to trickle up even faster when you compound a few of the items that you mentioned. Now we have a weaker dollar. I think we're pretty low right now. I think about 86. So, a stronger dollar would help offset these tariffs. But now we have a compounding effect. And then if they cut rates, it doesn't look too good there. Even Janet Yellen came out today saying that she believes inflation could go over 3% year over year based on these tariffs. Of course, she used the word transitory. They like to use that word a lot. But, so there's a lot of factors that are all aligning to demonstrate potential for this inflation to trickle up higher. Even though CPI came out, cooler, to me, the short term is noise. Every month to month. I don't watch the month to month. I look at the overall trends. Plus, I like to focus on the shadow inflation, because it's all in how they calculate this CPI,
Yep.
and what they calculate. And they pick certain items, they give more weight to others, and I have to admit it's easy to manipulate that number, just like GDP.
Nobody I know, if you talk to people in the real world, will say inflation is 3%. Nobody will say that.
Hmm.
Everyone will say it's 8 to 10%.
Absolutely.
Insurance prices, 10, 15% a year. I went to buy a steak at the grocery store. It's twice what it was a year ago. Just everywhere you look, these things are just more and more and more expensive. I agree with you on like the calculation of the CPI. I'll try not to get too into the weeds, but there were some weird things in this week's reports. For example,
Hmm.
in April, used cars went up 2.7%, and yet in both the April and May CPIs, they were negative. So, you have this like lag effect where like
Hmm.
it just hasn't shown up yet. And, next month it'll show up probably and it'll be a bigger deal than it should be because this really was an April story, not a, June story. In the PPI, which is, very important for how it feeds
Yes.
into the Fed's PCE, you had portfolio management fees, which is really like, did the equity market go up or down, right? Portfolio management fees were negative, even though April was actually a flat month. People are like still shocked by that it went down and then came right back up. And May was a very strong month of 6%. So again, portfolio management fees being negative, that that's going to reverse sharply at some
Hmm.
point in time. These weird little quirks, people get excited. What I'm hoping the Fed has learned from their prior mistakes, or maybe they don't consider them mistakes, but
No.
the prior periods where you had a 2 or 3 month window where inflation looked benign, they get very excited. They gear up the market for rate cuts. The market prices rate cuts in, obviously in anticipation of them being delivered. And that turbocharges the next leg of growth and then undermines the case for rate cuts altogether. This is what I call financial conditions loop dynamics, where anytime anything bad happens, we rush to price in rate cuts. When we rush to price in rate cuts, it then reaccelerates the economy without them having to even deliver the rate cuts. And so I hope the Fed next week is the Fed meeting, is takes the same stance they have been. We're patient. We're going to watch how it plays out. And the reason I'm very worried about them cutting further is I think we're at neutral rates now. We have a stable labor market at what they call full employment, 4.2%. Inflation has maybe moderated a bit, but it's still above target by a decent amount. Retail sales, consumption, still growing at a pretty nice level. GDP is growing around potential. So it just seems like you're at a neutral setting and you don't need to do anything. But you mentioned it and you're spot on. If they do cut, the dollar will get destroyed. And if the dollar gets destroyed, we're going to just add another inflationary impulse. So, it's a tricky dynamic for them to just sit because it just seems like they don't like to sit and wait for very long, but I think they need to sit and wait and really be two-way. If I were the Fed, I would stop having a bias to cutting rates at this stage. If you're at neutral, if you're at a neutral setting on the economy, you should say, we have no bias in either direction and we'll let the data determine. But because they constantly have this bias to ease, because they think they're deeply restrictive or whatever, they say, that is what keeps financial conditions very, very easy and undermines and it stalls the progress
Yeah.
on inflation. And we do this every 2 months. Every 2 months we go through this like loop dynamic. And it's
Yeah.
so it's easy to trade, frankly, but it's bad for the average American, in my opinion, who has to deal with the inflation.
Agreed. When the market prices cuts, they feed into the economy via lower market rates. It stimulates just as much as if they had delivered those cuts. So it's like a never-ending loop there, and they keep anticipating these cuts, and eventually, I guess maybe when they finally realize that we're not getting those cuts, but who knows? Maybe we will get those cuts. We never know what this Fed will do. And I want to separate the soft data versus the hard data. And that's important to break down. When we look at CPI, that's the hard data. That's like backwards looking and it's lagging. But the manufacturing, the new orders, the sentiments out there. You look at the NFIB, and I follow that closely. The input costs are much higher. And that was actually mentioned in the ISM report for last month. that input costs are higher. PPI came in higher, very little, but still came in higher, and they're revising them. There's upward revisions to the April
That
report, right?
the prior reports were revised up. The last two reports were revised up. Yeah.
Exactly. So we have this stealth inflation or this stealth economy that exists here. There's a lot of stealth markets out there, but it's there. It's like an undercurrent that's going on that even though they're showing us the CPI number, which we all know is fake. I mean, I agree with you. Inflation is around 8 to 10%. We can look at the cost of everything around us. The purchasing power, of our dollar keeps declining. Look at the Fred chart since like the 1940s, 1950s. We're constantly declining. I'm surprised they even keep that chart out available for everyone. But it's very concerning. And it's about the money supply, but it's also about the velocity of money. I always use the quantity theory of money. PY equals MV, which is the money supply times the velocity of money. So even though they increased the money supply, during the 2008, 2009 GFC, they had higher capital requirements with the Frank Dodd, they had, tighter banking restrictions. So the money didn't go out into the system. But now with 2020, the money went right into the economy. As they stimulated, the money went out there and we had runaway inflation. But I like your theory, Danny. You have the demographics element about the boomers. So please tell us about that.
Sure. So demographics is just one factor that in inflation. Obviously, the cyclical economy will drive a lot of things, right? The money supply, things like that, the Fed, policymakers. But demographics is sort of like a behind the scenes impulse on inflation. And for 4 decades we had a negative impulse where demographics were deflationary. Coming into this cycle, I already knew that this cycle would be just moderately more inflationary, and this is well before COVID, than the prior decade. And there's a number of reasons why, which I'll get into it, but effectively think of it like a beta. The beta may have been negative 0.5%, pretty consistent deflationary force that is now 0.5% positive. That swing is a pretty big swing for the inflation numbers that we get. And it's a big reason why we're sticky a little bit above target. So the way I look at demographics is via what I call the life cycle hypothesis. The life cycle hypothesis basically says that as a person goes through their life, their consumption patterns change, their investment patterns change, their productivity changes, what they consume and what they invest changes quite dramatically. But also a very important feature is their savings rate. And so when we were in the last cycle, we had a number of reasons why inflation was so low. And demographics is a big reason for it. And the other reason is the balance sheet recession. So naturally, housing market destruction and the equity market destruction and the deep recession we had in 2008 was a deflationary impulse. We had a desire to delever the banking system. That was a deflationary impulse. For a couple of years, we had a version of austerity by Obama. That was a deflationary impulse. And so these forces just took a long time to work through for the economy. But we also had the baby boomers at that stage about 10 years away from retirement, right? So at that stage, currently the median age of baby boomers is 72. They're in retirement. But at that point, they were about 62, right? If you go back to 2015, it was 62. And, if you go back to, 2012 or whatever, they were, 59, 58 years old. As you're at the later stages of your career, there's a number of things that, happen. One is your productivity goes down. That was a sort of negative GDP factor. You're older, you're comfortable in your job, you're not trying to kill yourself working 65, 70 hours a week. You're comfortable as a manager or senior person. But in your remaining years to retirement, your savings rates are as high as they are in your life. because you want to maximize how much you have in retirement. And so that was another deflationary force that we had in the last cycle. You turn to this cycle, the baby boomers have pretty much all retired. And so we took the biggest savers of the economy and we turned them into dis-savers. Now they have their pool of savings. Some of them are still invested in the equity market. So actually, their pool of savings could still be growing as the market continues to perform well. And they're drawing down those savings. That's why I call them dis-savers. So in aggregate for the economy, the savings rate, just by virtue of taking the biggest savers and putting them in retirement, the average savings rate for the, or aggregate savings rate for the economy has gone from roughly 8% to 4.5%. So, if you look at that, that's $3.50 per $100 of disposable income that we're going to spend $3.50 more as an economy. Circulate that around all the income that's generated. We just have a higher propensity to spend. So that lower savings rate means lower demand for fixed income, but it also means more spending. So we're going to have a shift up in potential GDP. Next up, factor that we have that's somewhat inflationary for this is we have millennials have moved into the peak home buying age, right? So they're at the age where they're building families, they're, want to have a house, they don't want to live in New York City anymore, they want to live in the suburbs, have a backyard and, good schools for their kids and things like that. Well, that means their demand for durable goods has shifted up. So housing, cars, things of that nature, we have a sticky demand for that. I tweeted about, the housing market is, in my opinion, clearly not healthy. It's not like a super exciting housing market. It's not, on fire or anything of that sort. It's not the picture I'm trying to give here. But there's a lot of people out there who think the housing market is going to fall apart. And they've been saying that for a solid year and a half. But as we saw last week, when you had 10-year yields move down to roughly where they are today, anytime yields come down, they jump in and you see a pop in the mortgage applications index of 10, 15%. Again, don't get super excited about that 10, 15% and think that means we're off to the races in housing. But what it means is the demand is there, and as soon as rates come down, they jump on it. And you have this loop dynamic where, again, that will then lead to better GDP in 2-3 months. You get better housing data in 2-3 months. And so clearly the demand for housing is there. It's just an affordability issue that remains, the case for many, many people. But the millennials are ready to buy as soon as they see a deal, either in price or in interest rates, they jump on it. And so that's a pretty consistent, demand feature. And again, that's also inflationary. Then you have, populist policies, which, Mr. Trump, the president, is a populist. Deglobalization. Again, all of these things are on their own also inflationary. And the last feature of the demographic cycle that I would say the demographic factors is we have persistent labor shortages. Right? So wages are still running higher than they were in the prior cycle. The labor market, even though now we're printing only call it 120, 140K jobs a month, which is very different than what we were doing the last couple of years, which was more like 200 to 250, the unemployment rate didn't move, right? The unemployment rate hasn't moved actually at all since the immigration flows really started slowing for the election last year. Prior to that period, you had a pretty sharp rise in the unemployment rate, which was mostly due to the increase in immigrant flows that was the supply of labor increasing. But without that, we're now at the point where we can see the true capacity of the economy. And that's different than what we had the last couple of years, where the capacity of the economy was higher just due to the amount of bodies that we were throwing into the labor market. So again, just another feature that will keep labor tighter than it otherwise may have been. is the composition of our labor force, is the aging population, is the retirement of baby boomers that keeps, persistent labor shortages. If I'll kind of characterize this a different way, the Liberation Day shock, if we didn't have the dynamics that I just mentioned in the labor market, I'm pretty sure we would have had layoffs come really, really quickly because that was a scary shock. But because the employers would look around and say, look, if we fire anyone and we have a mild recession of 6 months because demand falters due to this policy, that means I have to come back and hire these same people in 6 months. And it was pretty difficult last time to find workers, right? So what we're seeing is labor hoarding as a result of the demographic forces, and it just keeps the labor market tighter than it otherwise would be. And so that's why, a lot of people are worried about the labor market. I'm less worried. I do see some signs that maybe are a little concerning, like some data that is like gradually deteriorating, but nothing that tells me we're on the verge of like a big layoff cycle or anything like that.
Great points there. The boomers, from savers to consumers, massive spenders. We'll start with the labor market. I'm noticing the labor force participation rate, which is concerning. It's very low. I think it's 62.4%. I think it's lower than pre-pandemic still. And I even think it's lower than 2000. And that, there could be many factors. Like you said, the immigration. There's also the gig economy. We have this rise in this gig economy and a lot of part-time jobs, and everyone, it's just, I think what we're all alluding to is that there's a structural regime change and we're entering a new era, right? And it was the longest 40-year bond bull market that we had since, I believe, 1982. And now, I think COVID could have marked the bottom in inflation as well as rates, and that we're seeing a change now. What are your thoughts on that theory? And do you believe we're in for secularly higher inflation with potential, like you mentioned the taboo word of stagflation? We certainly have some stagnation floating around, and with tariffs, if they do get implemented at the levels they're talking about, can cause a global slowdown because, you and I are for free markets, and we want to, manufacture and produce, most efficiently. And so tariffs can be an obstacle to that, like you talked about with the supply shocks. So what are your thoughts on this next phase that we're in? Is it secular inflation?
Yeah, I do believe the demographic forces to me is what leads to secular inflation. And I think that's still something that the Fed hasn't picked up on. I also think, we had very specific circumstances around the post-GFC economy, as I mentioned, with the balance sheet recessions and all that, that are clearly not in place. Household wealth is skyrocketing. It's growing very rapidly. Household balance sheets, very low debt. Very low debt on the corporate sector. Net interest payments have fallen straight down as the companies locked in lower financing. On top of it, whatever cash on hand that they have, they're investing in, T-bills at decent rates and earning, 4.3%. And so when I look at the economy and the various, ways that monetary policy should be biting, it's through debt service costs rising for households to the point where this impacts consumption. This makes consumers want to be more cautious and save rather than spending. I see none of that. And the corporate sector, I don't see impacted by, the level of interest rates either. And, we're not seeing, I think you brought up the ISM surveys. I think that's a fantastic way to describe this. If you go through the most recent 2, 3, ISMs, services and manufacturing, try to look through and see, are they complaining about the cost of capital? The cost of capital is too high for us to invest, or the cost of capital is too high for us to hire people. You won't find any of that in any of the surveys. Nobody's complaining about the cost of capital, which is why I think the obsession with interest rates is actually dangerous, that people want to lower them. The reason people want to lower them is really they're higher than they were. That's it. And because they're higher than they were, they want them lower back where they were. but the economy has gone through a transformational change, and I don't believe we're going back to that world. And so I think it would be very, very risky for the Fed to lower rates any further from here. And so, yes, I think we're in a secular bond bear market for a number of reasons. The Fed in 2010 through 2019, because they were at the zero rates, they wanted to find other ways to stimulate. And the way they did that was these just huge QE programs where they were buying bonds. The reason to do that was to lower long-term rates so that the markets would go out, investors would go out to riskier parts of the market, credit instead of treasuries, or equities instead of bonds. And that was a way to stimulate the economy. Now, what it did do is it reduced term premiums in that part of the curve to a place where this entire cycle, because remember they did a lot of QE in 2020 and 2021, this cycle the term premium has been very, very low. When I look at the fiscal deficit situation, it's enormous, 7%, growing year over year again, bigger this year than last year, and looks like it'll be that way for years to come. I look at inflation that's already, we're in our 5th year of above target inflation. And to me, I don't see it being solved. And most economists, because of the tariffs, don't see it being solved this year or next year. So, I look at these factors, it says we should have a significantly higher term premium. And I'm just surprised that the bond market doesn't look around at any point in time. This is what we talked about rate cuts before, how the market's been obsessed with rate cuts. Even when they were hiking rates, the market was pricing, and in the interviews that Powell would give, the press conference, when are you thinking that you're going to be done? When are you going to cut? It was always about rate cuts, even when they were still hiking 75 bips per meeting. And the bond market, if you look at it, nowhere, not 26, not 27, not 28, none of these years, the bond market pricing a meaningful probability of rate hikes, right? Like there's no chance the economy will ever improve again and require rate hikes, according to the bond market. And so, this to me tells me that my biggest theme since 2020 has been to be bearish bonds. Doesn't mean I have the trade on at all times, but it means it's a theme that I'm very focused on. And when I see these dynamics and I see the disbelief over higher rates and I see people freaking out about a 4.5 10-year and things of that nature, it tells me that it's not over. So I think we will end up with significantly higher rates. It may be, I don't know what the catalyst will be. It may be when we do finally see tariffs hit inflation, and we get like a pretty strong print. Maybe that's next month, or maybe when this tax cut bill passes and people realize the deficits are set in stone. But I think we will see significantly higher interest rates. And that is the big risk to the equity market. If you want to look at a risk to the equity market, it's from higher rates at some point. At some point, rates will get higher than they should be. And we haven't had that all cycle, in my opinion. And when that happens, it could hurt equities. It could hurt credit too.
Absolutely. And we all know that the bond market does what the bond market wants to do. There was this great quote that James Carville, that was a political strategist to Clinton, who said, I actually have a quote right here. I used to think that if there was reincarnation, I wanted to come back as the president or the pope or a 400 baseball hitter. But now I want to come back as the bond market. You can intimidate everybody. So, the
You
bond
really
market.
can. If you go back to the UK in 2022, you had a prime minister who resigned within 10 days because of the bond market. When you go back to the week after April 2nd, the reaction for about 5 to 10 days after, where we had currencies, the dollar was getting killed. At the same time, the bond market was getting killed. At the same time, equities were going lower, which is very, very rare. I call this the doom loop. And when you get a dynamic like that, it's a sign of foreigners losing confidence in your markets. And so, that, tends to be a fleeting episode. You can't expect that at all times. The US is not Turkey or, some emerging market that has, that level of risk. But it is a sign that, the foreigners are getting uncomfortable with subsidizing these deficits. And look, you have a budget deficit of 7% and you have interest rates at 4.5%. I'm not saying they have to be the same level or anything, but
Hmm.
as a bond holder, I'm concerned that you're destroying the value of my bonds. If you bought bonds 10 years ago, due to the inflation we had this cycle, even though you had very benign inflation that cycle, if you bought bonds 10 years ago in 2015, you're underwater. So, people are rethinking bonds. They're coming to the conclusion bonds are risky. And, we had a very benign inflation print yesterday, and we had about, an 8 bip reaction in the 10-year yield, moved down 8 basis points from where it was prior to the number. We've moved a little bit lower today, but, I remember a year ago or 2 years ago, if we had a benign inflation print like that we would have rallied 15, 20 basis points. So the dam is getting closer to breaking on the bond market, in my opinion. And that's a big risk. And that is a big risk, and it's really hard to time it. It's really hard to time it. I did think a couple weeks ago we were close to breaking, but we then came back and everything seems fine today. But I do think it's going to happen at some point.
Yeah, we're seeing the 10 years coming down. I think it's at 4.3% right now. Now, I want to talk about the trading, the investment opportunities based on this dollar and the yield. So it's a pretty popular trade nowadays to be short the dollar. I think that's pretty common. And also long TLT. A lot of people tend to have this view that these 10-year, 20-year, well, TLT is the 20-year, but longer term rates are coming down. So they're long the TLT, thinking that these rates are going to come down. You, on the other hand, are believing that these rates are actually going to go higher, correct?
That's correct. I think we'll see something well above 5% before this story is over.
Wow. So that would
Hard
be
for me to tell you
shorting.
exactly when.
So that would be like shorting
Yeah,
the
short.
TLT. You'd be short the TLT.
Yeah.
Long term, like maybe
Yeah, I
looking
mean,
for
what we,
something.
what we see from the retail community is, well, first of all, and this is not their fault, it's a lot harder for the retail community to access the instruments to trade rates that professionals can, right? So professional investors can buy bonds and, they can finance that using repo. They can use swaps if they have the
Hmm.
relationships for swap trading. And then they can use futures and obviously options on any of these. But the retail community really like TLT, which is long-term bonds, is really their best, avenue to own any sort of fixed income. Whereas I would argue you're far better off just parking some money in T-bills and earning
Yes.
that interest than trying to bet on the capital appreciation of a long-term duration bet. I do not believe that these policies that their Trump administration is pursuing are good for bonds. I don't think so. And I also am of the belief that growth is stronger than people give credit for. I don't think they've recognized that the demographic shift from immigration ending means what people are viewing as weakening is really just a new capacity for the economy. And I can explain what I mean by that if you want. So
Yep.
I think what we see from the retail community is they are constantly looking to, bottom tick bonds to try to say, I got it, and then we go all the way to zero or we go all the way to 2%. And, they really want it's like a badge of honor to say I nailed, the top in yields. And so I almost view it as like a sadistic self-punishment that they're doing to themselves because they do this over and over again. And then you'll get last Friday and it'll just smack them in their face and they have to stop out of it. And so I think, these dynamics, make it very, very challenging for retail. And I think they should avoid TLT. And if they want to own fixed income, try to get like the front end of the curve or own some tips that'll protect you in case inflation goes up, things of that nature where real yields are at a decently attractive level, historically. The dollar short, I think, is a multi-year story. The dollar tends to go in these 10-year cycles, and the dollar has been a one-way freight train stronger since basically 2014, 2013, 2014. And, I think now there's many reasons for the dollar to be weakening. Should be a core trade. This is one, and I think it is the most important trade out there. I think it's more important than equities. I think it's more important than bonds, is what the dollar is doing on a regular basis. The dollar is selling off pretty consistently, no matter if we have stronger data or weaker data, right? No matter if we have a risk on or a risk off. It is a pretty consistent trade. And there's fundamental reasons for this. And I think they're going to continue. The Trump administration wants to narrow the current account deficit. That's, why they're doing trade wars, trade tariffs. If you narrow the current account deficit, there's two properties of the current account deficit. One is exports minus imports, obviously, straightforward. The other is savings minus investments. It's a mathematical property of the current account deficit. If you shrink the current account deficit, if that's the goal of the administration, that means that either you're saving more or as an economy, or you're investing less as an economy. Either of those are growth negative and make the US less exceptional than it used to be. And so that is a negative that has been priced into the FX market. The FX market has been smart about this. Secondly, is if you have a smaller current account deficit, it's about 3% of GDP now, 3 to 4%. Imagine it were 1% of GDP. Well, that means on a going forward basis, we're delivering less dollars to our to our trading partners, those that export to us, that we import from. We're giving them fewer dollars to invest, and they have historically taken those dollars and instead of converting them back to their local currency, invest in tech companies, invest in treasuries, invest in US assets, corporate bonds. And if we're delivering less dollars, there will be less demand for US assets going forward. That is also dollar bearish. And then, last but not least is the 10-year bull run in the dollar, 10, 12-year bull run has led to foreigners accumulating a lot of dollars, meaning they're overexposed to the US economy. They're overexposed to US markets. And so a lot of investors, we've seen in Japan, we've seen in Taiwan, we've seen a little bit in Europe, are sitting down, they're asking themselves, they're doing, committee meetings and saying, do we want to be this exposed to the United States? And some of them are saying we want to take money and bring it home. But others are saying at a minimum, we have to hedge what we own because the dollar, if it weakens, means our returns in our local currency are going to be negatively impacted by the dollar. If you're a European investor, equities are down pretty sharply this year for you, even though the S&P is slightly up on the year. Equities are in euro terms, so significantly negative. In yen terms, significantly negative. So foreigners are, coming to grips with the fact that they need to hedge their currency exposure. Mm-hmm. So I believe that, this will be a multi-year story, and it has major implications. It loosens financial conditions. It improves liquidity. It will flatter corporate revenue, so it makes the S&P a little bit, their earnings look a little better. 45% of earnings are abroad. So as the dollar weakens, translating that back to USD will be good for their earnings. And it increases inflation. It has all of these features. So to me, the dollar is the most important story. And it's a big reason why gold has been on fire. Gold is like another alternate currency. And gold and Bitcoin, both of them considered USD assets have done exceptionally well. People are looking for other places to park their money rather than in the US dollar. So I think this is a big story. The concern I have is that this could go too far. And, we already, if you look at the relationship between interest rate spreads, like usually currencies are a function of the relative interest rates between the two economies, we're already pretty dislocated on these metrics, and it can get even more dislocated. But the point is that at some point, the dollar could weaken so much that either bond yields need to rise significantly to attract foreigners, or the Fed may have to hike rates, even though they don't want to make the dollar stabilize, to stabilize the dollar. I call this the doom loop because this is what happened from 1979 to 1981, coincidentally, the last inflation cycle that we had. And in that situation, they tried to stabilize the dollar using all kinds of tricks and gimmicks and, let's use gold to stabilize the dollar and let's use that, and nothing worked. And eventually, Volcker had to go nuclear on the economy. He had to do it. And when that happened, the dollar regained its footing. We may have a situation like that, in 9 months, 12 months down the road. It's not a today story, but it's a story that I think every investor should be focused on, should be paying attention to.
Absolutely. Keep our eyes on that. And that cycle that you're referencing in the 70s to 81 was also stagflationary cycle as well. Gold passes the euro as the second reserve asset that central banks are buying. What are your thoughts on gold here?
I had a bearish view on gold, call it in April, where I think it got very crowded and it looked like it was on the verge of rolling over. But I'll kind of break out I have a nuanced view on gold. The reserve currency story, that makes a ton of sense to me, right? Gold is a physical asset. It's a tangible asset with limited supply. We don't have a good risk-off instrument because of bonds not behaving the way they used to. So in that context, to have gold as a differentiated reserve asset, to me, makes a lot of sense. And we've seen that. China, India have been, and I guess Russia, have been the three biggest buyers of gold in the last 12 to 18 months. I don't see why other reserve managers, Europe, Japan, others, cannot also join in on it. So I think that story makes a ton of sense and can certainly continue. And especially when you look at what the dollar is doing, as long as the dollar is down, 1% or give or take like it is today, I expect gold to go up. But there are other stories that I find get applied to gold that I don't believe in. People call it an inflation hedge. People call it a equity hedge. And if you actually go look at the periods where that happens, like in inflation in 21 and 22, gold went down 20 odd percent. In equities went down in 22, gold went down. In Silicon Valley Bank episode, gold went down 5%, didn't protect you there. In August 2024, gold went down 5%, in the VAR shock that we had there. And in Liberation Day, gold went down 10%, give or take. So I think when I see these narratives applied to something, that it's like gold is bulletproof, the most fantastic asset in the world, that's when I get nervous about it. And I'm probably, as a contrarian, looking to short it. But I don't see that at play right now. I don't see crowded positioning. And I see the dollar weakening. So to me right now, I think gold has good runway. But when you start to hear these nonsense theories about it, that's when I would say to investors, maybe take profits. Maybe you don't have to short it, but maybe take profits, wait for a new opportunity to buy, when the narratives get a little out of control. So that's what I view on gold. And I think I'm long silver here. I think silver still has a lot of catch up to gold, and silver also has commercial properties. And we're seeing other metals also going ballistic. Platinum, palladium, it's not just, gold. Copper is obviously very important. It's had a good run. And I think, what we're seeing is the commercial usages of these metals is also very important. And, Trump is also talking about, putting tariffs on them. which could raise their prices. So I definitely think commodities are a great asset class to be considering. One of the most famous commodity is oil, and people have been bearish oil forever, the last few years. Since 22, I think everyone I've seen has been bearish oil. OPEC raised production 2 straight meetings, and yet oil is higher than it was before they started that process. And I think nobody expected that. People were saying we're going to get low 50s or maybe even 40s in oil. We're on the verge of touching 70 right now. Some of that is, this Iran headline in the last 24 hours, but we've been substantially higher than where people thought, and I think oil is also something to be concerned about. Is it doesn't take much for this thing to go up $15-20, and if that does, what does that do for inflation? What does that do for consumer budgets? Not a good thing. So I would say oil is still a good market to watch too, but I think commodities in general, I'm very bullish on them.
Well, that's in line with your potential for stagflation as well, because in stagflation, commodities, the real assets is where you want to be positioning yourself. And I think that in portfolio management and allocation, it's always nice to have a little portion of your portfolio in these real assets. And, I like to talk about the various asset classes. I know you specialize in the mispricing of asset classes based on your macro analysis. So, and there are a lot of opportunities out there. And also, you mentioned Bitcoin. So, I like to get your thoughts on Bitcoin and these crypto. Do you think that, being that this is the most pro crypto administration, and they're pushing these bills, the Genius Act and other, Bitcoin Reserve. What are your thoughts on that asset class?
Well, I'll caveat that I've always been a Bitcoin skeptic. And the reason is I've never found, I did a lot of research and you would hear all these, it's similar to the gold, narrative. You'd hear a lot of reasons for Bitcoin to perform. They didn't always make sense. Like is it a storage of value? Is it an alternate currency? Can you transact with it? None of these stories really added up. I ended up in January this year doing a significant research project on Bitcoin, and I created a model for Bitcoin. So rather than being a buy and hold Bitcoin guy, I'm a systematic investor in Bitcoin when my model gives me a signal. There's really 3 factors that I found drive Bitcoin. One is global money supply. So when money supply is rising rapidly, Bitcoin tends to do well. Loose financial conditions is an example of that, like loose monetary policy. I find it has a correlation to the NASDAQ, to a levered NASDAQ. It's effectively like a 3x NASDAQ. Bitcoin is very similar to that. So risk appetite doing well, it tends to do well. But then there's a third factor, which is that I think the most misunderstood about Bitcoin. Bitcoin itself is always talked about having limited supply, 21 million coins. Although we don't know what'll happen when we hit that 21 million limit. If that'll actually cause supply to just flatline forever, or if they'll find a way to increase supply. It's not impossible that they find a way to increase supply, which would undermine a lot of it. But even though Bitcoin does theoretically have limited supply, crypto as an asset class does not. So what do I mean by that is you could create a row coin right now if you have the technical expertise to code it that uses the same mathematical code that Bitcoin does, because Bitcoin is open source code. They never patented it, right? So when we think about software, which is essentially what Bitcoin is, when we think about software, it's valuable. And so companies will patent it. Microsoft patents, Microsoft Office, Excel, Word, and PowerPoint. And that's why there really hasn't been a good replacement for it, because if their code was open source, anyone would, lots of copycats would create their own version of the software. No one's been able to do that. They keep their software, proprietary. Apple keeps their iPhone store proprietary and things like that. Bitcoin is open source. And so when Bitcoin does well, we tend to see a lot of copycat coins or other coins come into existence. You know, fart coin is out there. There's Trump coin. Some of them are just complete nonsense. But as the aggregate supply of crypto grows, crypto becomes more vulnerable to the downside. So it's like any other asset. When supply increases, it's less scarce. And so the reason I looked at this is in 2021, when crypto was going, ballistic, and all risk assets were going ballistic, we had a huge increase in supply. We had FTX coin, we had a coin from this exchange, we had JPEGs and people with monkeys and whatever, like all this like nonsense. But the supply was growing. And it meant that it doesn't mean that the market had to go down 80%, but it meant that we were vulnerable to such a decline. And it just so happened that the Fed, came in and was hiking rates in 22, and we did have that decline. But then once we had that decline over the course of 22, we destroyed a lot of that supply. A lot of that supply was actually destroyed. A lot of, ICOs and things like that, they went bankrupt. And when you destroy supply, you actually now create vulnerability to the upside. Something that's more scarce has more upside than something that's less scarce. And so, that dynamic is actually really interesting because the supply is increasing and it's creating downward pressure in my model on Bitcoin, whereas everyone is extremely bullish. So as of today, my model says, and I think we're trading around 108 or 109K. Mm-hmm. My model is saying 94K is where we should be. And that's a pretty big dislocation. So right now I'm short on the model. The model's done very well. It's done well, 7 of the last 7 times I've traded it since it's been live. But it's not like I'm not a permanent guy in these markets. I'm a tactical investor when my model gives me a signal. Right now, it's giving me a short signal on Bitcoin. And I think, it looks like the vulnerability to the downside is growing. But we'll see. It doesn't mean that the supply has to keep increasing. But if it does, it opens up for a significant downside.
Yeah. Well, I think that's really smart because this is the type of market that is a very volatile market. It's a tradable market. I think that this new structural regime that we're in is more for active management rather than that passive investing. I think we've changed. And so it's being tactical, as you just mentioned. And when you chart Bitcoin right now, you see it has like a formation of a double top potentially. I mean, charts are just like economics. You can look at the same chart and different people can see different things. But when I looked at it, it looked like a double top. So, like you said, 90s, 94 makes sense to me. It can come back down. I think it's a little toppy right now for this short-term cycle. But, long term, they're claiming 1 million, 13 million, who knows?
When I was much more skeptical about its viability as an asset was because it was still very fringe. It was very fringe. The purpose of it wasn't really outlined. You had to use like these exchanges and cold storage and more complex ways to access it.
And if you lose your words, you can lose everything.
You can lose it. There's stories of that. People lost like $100 million fortunes and whatnot because they lost, a piece of paper. It's ridiculous, but it's ETFs now. It's far more accessible. Like you mentioned, you have a very crypto-friendly administration. They're talking about, maybe a reserve. I don't know, that hasn't really materialized the way people were hoping. But it's undeniable that the Trump family, especially his sons, are very involved in crypto and see value in crypto. And so that does breed legitimacy to it that didn't happen before as an alternate asset. And at a minimum, people can say, this thing should be uncorrelated to my IBM or my Apple, stock that I own, in general. And so I think that does lead to legitimacy and staying power to it. that we didn't have before. So my prior skepticism would have me say, I think it's worth zero. And now I have a model that I'm comfortable saying it's not zero. It has staying power. It's not going anywhere. We have enough time to say that at this point that it's not
Yes.
going anywhere. And so but that being said, I'm not a buy and hold investor in anything. I'm a
No,
macro
great.
trader where when I see asymmetric opportunities and I trade mostly via options, I'm going to jump in and do that. I get plenty wrong. I'm trying to get, a little over 50% right. And, hopefully my wins are bigger than my losses. And that's the nature of my trading. So,
Yeah.
I have a good model for Bitcoin, but again, it's when I see the stories of, a million or 5 million and what MicroStrategy is doing and all those games. It does raise my alarm bells a little bit on
Yeah.
being a little more
Right.
skeptical.
Exactly. So let's speak about equities. I mean, I think that's the sexiest and most exciting asset class out there. Retail definitely loves that one, and I think we all do. There's AI stories, huge. There's quantum, a lot of speculative areas. There's aerospace, the aviations. There's just tech. There's so much out there. And what are your thoughts on all of it? Are we filling this bubble in the making? You referenced 1999. And I lived through that time. I was actually, that was the beginning of my trading career. And I remember that time. And I remember 2000. I remember all those IPOs coming out and all these the dot bomb, we called it. All these companies that weren't making any money just put a dot com at the end of their name, and everyone invested in them. Are we in this potential bubble for AI? Do you think it still looks strong maybe for another few years here? What are your thoughts on the short to mid-term and then the longer term, which gets a little murky, I know.
Yeah, I mean the importance of AI and how much companies are investing in it is material. So even in the midst of Liberation Day and the madness of that, when we got the Mag 7 earnings come out, they came out and explained their CapEx budgets, which are huge. They're just massive amounts of infrastructure that they're spending on AI. I think we're at the stage where they need to start delivering, monetizable ways to take advantage of AI, right? Like, it's nice to build that infrastructure, but it has to show results. I do like the 99, 98, 99 parallel in many ways because valuations now are very comparable to that period. And, it does look like we're going to get to bubble territory, even though I don't think we're right there yet. I
Mhm.
think we're on our way there. Valuations are very elevated. Now, of course, valuations don't tell you anything what the market will do in the next year. They are very good at, saying long-term returns will be weaker going forward. Like a 5-year, 10-year outlook would be a lot less sexy for the equity market given where the starting point of valuations is. But recessions have a tendency to cleanse that out of the system. So it just could mean we're vulnerable to a big decline in a recession, bigger than we otherwise would have had, and that will normalize these relationships. But there's similarities and differences to the dot-com period. The big difference I would say is, we're dealing with companies, even in AI, where we still don't know what AI fully will deliver to the economy yet. We don't know yet all the applications of it and how companies will make money from it. But the companies themselves, the big guys, the Mag 7s, they generate an enormous amount of earnings and free cash flow. So it's very different than the dot-com situation where you had pets.com and radio stations online and all these things that nothing was generating money. Amazon wasn't generating money. It was just like a vision of something. And so I think it's very different than that environment in that these companies are genuine powerhouses of free cash flow generation. So I think, there's plus if you go to outside the tech companies, a lot of the, industries like small caps and, other sectors, they're not particularly expensive. They may be a little bit expensive, but they're not like screaming expensive as much as the tech companies are. So I don't think the valuation story is, perfectly comparable. Where I think it's comparable is, we have huge, easing in financial conditions. We had a Fed panic rate cut cycle last year that is similar to the rate cut cycle after cutting in 98. And I think the wealth effect from this huge equity run that we've had for, going on 3 years now, for more than that actually. Um, I think that wealth effect is a big driver of the economy. And so these dynamics make it very, very similar to me. So, I think the market will keep going as long as the following conditions are in place, which is as long as jobs are still there, as long as we don't have a big layoff cycle, as long as people still have jobs and they collect paychecks, I think that money continues to flow into the market. As long as the dollar is weak, that's very easy financial conditions that supports the market. So I think that will continue. And then I believe rates are below fair value. So when you have rates that are below fair value, like for example, the Fed funds rate is 4.3 and the 10-year rate is 4.3. Like there's no term premium, there's no like curve steepness, there's nothing there. And so as long as you have rates below fair value, I think the 10-year should be closer to 5.5. I think these things just, are going to continue pushing the market higher. And I would hope the Fed would, at this point of the cycle, realize financial conditions are too easy for them to achieve their, objectives. And so I think the market will keep going. What I'm really focused on now, short term, is I think it's like a small cap summer where I think the Russell 2000 starts to catch up because I think the economy's fine. And as we have this situation with easing in financial conditions, I think that area of the economy is going to be the outperformer from here. And we saw a decent amount of that, not today, but we saw a decent amount of that the last couple of weeks. So I think the Russell 2000 could go up like 20-30%
Wow.
in a pretty rapid fashion to catch up to some of these markets. Everyone is overweight Mag 7 and everyone is underweight cyclical parts of the economy. And when you see commodities doing what they're doing, when you see the lending story picking up, that to me is telling me the cyclical part of the economy is actually picking up. Now, that doesn't mean it's picking up for 2 years. It could be picking up for 3 months. But it looks to me like we're seeing a sequential improvement in the cyclical part of the economy. Like I mentioned, housing mortgage applications better than people expected. Industrials is actually the leading sector in the market, right? Financials are doing quite well as the yield curve steepens, and deregulation will benefit all of these, areas. The tax cuts will also benefit small businesses, a material amount. Deregulation will benefit small business in a material amount. So I think that actually these are the interesting areas to be looking at right now is the Russell 2000 or cyclical sectors that I think can outperform. On a longer term basis, for longer term investors, I'm really interested in a couple sectors. One, I think the defense sector continues to be a good one. I think the defense, the needs for modernizing and upgrading US military capabilities are going to be with us for a material amount of time. I mean, there's multiple wars going on, and we're potentially talking about a third one, right? Israel has had a number of conflicts, and the US has, provided ammunition to Israel. Ukraine is still going on 2.5 years later. Sorry, it's already 3 years later, still going on. And on top of it, there's the risk of Taiwan at any point, and let's hope it doesn't happen. But I think the defense sector is a good one. I think it's good not only in the US, I think it's good in other sort of ally countries where the US is asking them to invest more in defense, like NATO countries. But then within tech, I think that the sector I'm most interested in is robotics for long term. It's not short term. And here it's related to AI, but I think it's more related to if we have a desire to bring manufacturing back into the United States, It's not going to be, you and I working and putting together t-shirts. That's not the manufacturing they want. They want high quality tech manufacturing and defense manufacturing. And to me, that screams robotics, and the robotics that China's ahead on this, and the US is going to have to catch up, because I think to be a leader in manufacturing requires robotics, doesn't require, people assembling iPhones with their hand. It's not going to be, rebuilding the textile industry. It's not going to be those sectors of manufacturing. And I think, so for high-end tech manufacturing, robotics is big. And we're starting to see some serious developments in this area. In particular, I said China, but Tesla themselves, they're working on, I think it's called Optimus, and it looks impressive at what they're doing. Amazon has invested heavily in robotics in their warehouses. So I think that's the next, big theme within tech is going to be, robotics. And there's not a great, I don't have a great investment vehicle. We don't have like a clean ETF or something for that yet. It's really individual companies, which is not my world. So I can't actually promote anything here, but I do think that will be, the next big story in tech.
Yeah, it's a great point. With reshoring taking 2, 3, 4, 5 years. If you bring back manufacturing, I think there's going to be a structural change as well. The rise of AI and robotics. I think people need to just think differently. That we're not going to be assembling iPhones and printing T-shirts like you said. We're going to be using robots, and we see that with Tesla and Amazon. If you see recent videos of Amazon and their fulfillment warehouses, they have, robots doing all their fulfillment. And that increases productivity and it's highly efficient. You can do the work of 10 people in like an eighth of the time. And it's a new world, a new way of looking at things. Great points, Danny, on the long term. I like the defense angle as well. Summer of small and mid caps. I've been feeling the same, that there's a lot of value in those smaller names which have been overlooked because of the Mag 7 attraction. Plus, that point that you make about, when people thinking rate cuts are coming, it's the same effect as the rate cuts occurring. Well, then you could say that with small and mid caps because they're the ones that
They
benefit the
benefit the
most.
most.
Exactly, right?
Yeah,
They
they
benefit the
benefit.
most from the cuts. So it's just as if we're having those cuts and we'll have those small and mid caps benefiting from that. And you add a practical sense. I wanted to just wrap up with the rate cuts, the whole issue about the recency bias. I think people have a recency bias and they think that rate cuts are coming. The market is pricing them in. So then they take part in the buy now, pay later, and they keep delaying. And that's why they're accumulating more debt. And they're thinking that they're going to get rescued and that the Fed's going to come to the rescue. But I think these times are a little different. They may have to get a reality check that it's not going to be the same as it was in the past and that rates are higher for longer, but they're actually not that much higher. Historically, they're not that
No,
high. It's just that, like we say,
no,
we compare them to the recent past. So relatively, they are higher from ZERP. Anything's higher than ZERP,
that's right.
right?
And it's unfortunate because people who had the ability to lock in mortgage financing at like 2.5, 3%, when that was available in 2020 and 2021, and you have other people who want to buy a home now and that's not available to them. And so they're yearning for that opportunity, but it's not coming back. You're never getting those rates again.
Great, yeah.
And so, I think it's an adjustment process for the economy to say, that's not going to happen. And we're now multiple years of rates at these levels and nothing's broken. So clearly, fundamentally, I think the economy's fine at rates at these levels. It's just psychologically people don't like that rates were significantly lower than they are today. And that they're not able to access that, unfortunately. But I think that adjustment, is starting to happen. And there's this sort of view out there like continuing claims was a little bit higher today. So, oh, we better cut rates. And there's this view out there that, people have this ability to forecast weakness in the economy, and we need to get ahead of weakness in the economy. Well, the same people who are saying that today were the same people saying that when Silicon Valley Bank went under, the same people who said it in, the end of 23, the same people who said it at the beginning of 24. They said it last summer when we had a wobble in the labor market, and they said it again, now in this period. And I think, the problem is, anticipating weakness is fine if we don't have inflation. But when you have inflation and when you have the problem that we have, if you go early, you are going to cause inflation to bounce. And that's why when they cut aggressively in September, long-term yields went back up. It started anticipating more inflation. And so we're not in that world. And, I think we already got 100 bips of cuts, preemptive cuts, when we did not have a weak economy. And I think what people need to realize is, and I hope the Fed, they've talked a good game, and I hope they stick with it, is when there's actual weakness in the economy, we will get rate cuts. We'll get material rate cuts, but you don't need to try to be, a forecaster and predict that weakness and say, let's cut now. And our obsession with doing so is leading to us not finishing the job in inflation. And it's the reason why inflation expectations have started to get unanchored. They actually started to get unanchored last year. I've been very focused on it. And the reason they started to get unanchored last year is, we have inflation persisting for longer than anyone anticipated. And we have a Fed who says, yeah, it's elevated, but we're not going to do anything about it, right? Like we're just going to sit here for a while and hope it goes away and just goes away on its own. Well, as a consumer, that doesn't give me confidence that inflation's going away. If anything, that effectively just tells me it's not going away, right? These sort of promises have not been, kept by policymakers. And so I think this is very, very dangerous for the markets to be pricing rate cuts. That being said, if we have a 5% unemployment rate, the Fed should be cutting a material amount. But we shouldn't be, if the unemployment rate goes from 4.2 to 4.3, there's nothing that says it can't go from 4.3 back to 4.1. And people want to jump on it and deliver rate cuts, and it could backfire in a big way. And I anticipate it would backfire in a big way. So I think, this adjustment process is still not complete for people to get used to higher rates. And, I think, the concern is that by pushing these easing expectations too much, we risk an out of control long end of the curve,
Yeah.
which can cause some serious damage to the economy. And so, that's where my mind is at. And the most asymmetric bet that I see is, yields going higher than anyone thinks, like 5.5, maybe even 6%. That doesn't mean next week, but 5.5, maybe 6%. Nobody's ready for that. Options on these scenarios are very cheap. And so I like putting some capital on like these like tail moves in the bond market. And or betting on zero rate cuts this year is still an asymmetric, bet. That's kind of where my head's at
Yeah.
on interest rates, with it. So yeah, I think we covered all the big asset classes,
I
thankfully.
think we did. I like the contrarian view. You put your money on those little tail because they could pay off pretty
Yeah.
large if you hit them, right? The inflation expectations going higher is very concerning, and that's something that people need to understand when they're wanting all these rate cuts and more loosened conditions than we have. Apparently, we have liquidity. We have the markets running. There's obviously liquidity, Bitcoin like you mentioned, and we have loosened conditions. I want to end on just a last note with the debt. Debt and the public debt over 37 trillion. You mentioned Silicon Valley Bank. A lot of banks have unrealized losses on their balance sheet. And that's a concern with these higher rates. Now, that's an argument that people sometimes make. They talk about this, a lot of, I think 9 trillion needs to be refinanced this year. We're paying over 3% of our GDP to service the debt. Our debt expense exceeds $1 trillion. Do you believe that, and a lot of people make a case, I think Paul Tudor Jones came out yesterday saying about rate cuts, how we need to lower those rates because of this public debt that's getting refinanced, and then to pay new debt. What are your thoughts on that? Do you think it's important to lower rates to help with the debt the massive debt that we have?
No, it's really simple. If they want to deal with the debt problem, it's not forcing monetary policy to loosen, which can come with the adverse effect of higher inflation. Or it could also create bubbles in the markets that then can be catastrophic down the line. And I think people are way too complacent about that because, everyone owns equities and they're happy that it's going up every day. Like, it feels nice. You're not concerned about bubbles. But when you have a bubble bear market, it's not 20, 30%. Like the NASDAQ went down 80% in the 2000 bear market. The S&P went down, I think 55 or 60%. In 2008, they went down like that. So, I think there's adverse consequences of easing policy for something that's away from the economy, that isn't driven by the economic situation. And secondly, do they look serious about dealing with the deficit? If they were serious, they wouldn't be extending tax cuts. Doge was a complete joke, and everyone knows it was a complete joke. I've said that from day one. It was not going to be realistic for them to cut $1 trillion a year or anything meaningful in that, front. So, they're not serious about the deficit. I don't see why, forcing the Fed to cut rates is the right answer. I understand a lot of people are, concerned about that. But first of all, what happened? Let's just go through this. We went to in September, we cut 50 basis points, right? The Fed cut. And within the flash of an eye, 10-year yields were 100 bips higher, right? And so can we even time the issuance calendar to issue more debt at lower rates if they don't even stay there for more than like a flash, for a blink of an eye? Because that's what would happen, right? If the Fed cut to 250 by the end of this year, we'll have 7%, long-term rates. Where will you have been able to issue? In fact, what it'll do is you'll be stuck issuing at the front end of the curve forever, and you'll cause problems because the economy won't function with long-term rates at those levels. So I don't think that works. It really simple is, we do have a deficit problem, but when you look at the budget, there's basically 4 categories that are a problem. One is entitlements. The other is defense. The other is non-defense discretionary spending, and then interest payments. So let's go through this. The non-defense discretionary is the lowest as a share of the budget or the economy it's ever been. So there's really not much we can squeeze out of discretionary government spending. And so the Doge stuff was really targeted this and really was never going to be much of a big impact. We already talked about defense. I don't think there's any initiative to shrink defense spending with the risks that are around the horizon in the geopolitical context. So I don't think that's realistic. Interest expense, they screwed this up. In 2021, 2020, 2021, you had the lowest rates in history. They issued a lot of short-term debt rather than long-term debt. It was their mistake. They were concerned. I mean, I understand why. They were concerned that if they issued 10 and 30-year bonds at that point, that those rates would rise and it would undermine the economy. But in 2021, the economy was on fire. And a little bit of taking that on fire down to like just hot may have prevented the Fed from needing to hike to 5.5%, So I think they missed their opportunity on the interest expense. And I don't think we should just blow up the economy today to make up for that mistake. I don't think it's realistic. And I think, we have to live with that mistake. And then, entitlements is the big one. And if they don't deal with entitlements, they will never get the deficit under control. And so it's very uncomfortable because politicians don't want to deal with entitlements because it's very, um, important to their constituents, in particular lower income households are heavily reliant on Medicare, Medicaid, and seniors as well are very reliant on these, and Social Security payments very reliant on these. And so it's a very difficult thing to do entitlement reform, but they're going to need to because in 5 years, give or take, Social Security will be underwater, and if we don't deal with it in the near future, we'll have to deal with it then. And my estimation is it'll cost anywhere between $5 and $8 trillion to do that. So, to me, it's entitlements that's the story. And the interest payments is unfortunately large, but I don't see why you can just force that to be the solution. If you're serious about the deficit, you're not going to extend these tax cuts and create 5 trillion more of deficits over 10 years. So, I think you can't have it both ways. You have to pick and choose. If we're serious about deficit reduction, it means having a pretty negative economic outcome, probably a deep recession. But then that recession will bring rates maybe not to zero, but it'll bring them low enough that you can then issue debt at lower levels and, average into lower levels than are currently today and deal with the interest expense issue. So it's related to deficit reduction in that way. But if they're not willing to do that, if they want the economy to run hot like they're talking, then, it's not going to happen. So my opinion is it's not going to happen. Yeah. We saw them talk tough on the deficit to start this year. I was calling BS every step of the way. I knew it was BS every step of the way because on the one hand, you're talking about reducing the deficit. On the other hand, you're extending the tax cuts. It was never serious. And I always knew that Doge was just a sideshow to try to distract us so that the bond market doesn't revolt against the tax bill. It didn't work. And gimmicks don't work. You need to get serious about entitlements if you want to reduce the deficit. And it's a very politically difficult thing to do, to deal with entitlement reform, to strip these benefits from people who need them would mean any given senator who votes for this loses the next election. And that's why it doesn't happen, right? If you're, I don't know, senator of Colorado, and you go home and you strip these benefits from people, good luck getting reelected. And so as long as politicians are worried about their own career and not, what their constituents are worried about, then it won't happen. And so I'm pessimistic on the deficit. And, I don't sit here with the conspiracy theories, but it may at some point get to a really ugly situation. But I think the real solution is when you get to a recession, you are actually able to sustainably cut rates, not cut rates for gimmicks, not cut rates just for the sake of it, not cut rates because we think inflation is beaten for 3 months, not cut rates because we're anticipating the labor market breaking in 6 months from now or whatever, not, imagining reasons to cut rates. The economy is weak, and when you cut rates, they will stay lower for a good 6 to 12 months before you need to raise them again. It gives the Treasury time to say, let's lock in our financing. It won't be zero, but it might be 3%. And that's better than where we are today. And I think, that would make a material difference. That's how I look at it. And as long as this deficit is going to be as wide as it is, it's going to support the economy. It's going to support markets. And it, at the same time should have higher interest rates. But I don't see this changing. I don't see it changing.
Yeah. Well said. We don't want rate cuts. That the idea, the fantasy of them, I think is having enough of an effect on the markets that we don't need to actually put them in place and then have runaway inflation expectations and then the long end blowing out. That would do much more harm and damage to the economy in the mid to long term as well. We need to reduce deficit spending, and it's harder, politically And there's only been a few presidents in the recent past that have done that, Clinton, and then Reagan did it in a second term, and then Eisenhower. It was a difficult thing. I mean, of course, Clinton had the benefit of reduction in defense spending because of the end of the Cold War.
Yeah,
So
and Reagan was willing to take on some pain in his first term, and he
exactly.
won an election in spite of it. Trump only has one term here, and I think that kind of also was part of the story is does he really want to go through 2 years of pain and then
Mhm.
potentially lose the midterms and then not have the capacity to enact his agenda?
Mhm.
Um, Now, maybe after the midterms, he'll get serious. It's possible. It's possible, but again, it has to be entitlement reform. It's not going to happen because Elon Musk comes in and finds magic to do. It's going to happen because Congress sits down and they roll up their sleeves and they say, "Hey, we have to
Mhm.
deal with entitlement reform. Deal with entitlement reform. Deal with the deficit. You may then get a slowdown, a material slowdown that you can then refinance. But there's no other way to do it. It's like if you have a kid and you give them your credit card and you tell them to go to this, they can go shopping and you don't put a limit on it,
Yeah,
right? And then you can't try and find gimmicks. They will spend unless you cut them off.
exactly.
And we're effectively in the same situation,
Yeah.
right? So if you give them an unlimited limit on their credit card, don't expect them to be the best at budgeting, a 15-year-old, like they will spend. But if
Yeah,
you give them, a $200 a month limit, they will have to learn how to budget and only buy what they need and or wait and save to buy something that they want and so on and so forth. And they won't spend out of control because they can't. And effectively, we have to do the same thing, but there's no appetite for it. So I'm not holding my breath. And
yeah,
when you
agree.
get these theories out there, I don't even waste my time with them. I don't
Agree.
I don't live in theory land in the real
Yeah,
world.
that's fairyland that they're going to cut their spending and stop spending like drunken sailors, right? So it's like an
Exactly.
unlimited Black American Express card. They just keep spending. So this has been
Yeah.
wonderful, Danny. I love speaking with you about the economy and the markets. You have very sound theories and thinking on all these issues, and we appreciate that. So please tell our audience how they can follow you and read more of your writings.
Sure. So on my Twitter is Danny Dayan 5. On my Twitter profile, I have a link to the Macro Musings, Substack, where I do a lot of research on the economy. Sometimes it's just simple recapping of economic data. It's other times more deep dive thematic views into the economy, monetary policy, other features. And then I have a chat room where I'm sharing all my trades with clients, everything that I'm doing in my own portfolio, real time, as I'm doing it, as I'm taking things off, as I'm stopping out of trades or taking profits or hedging trades. They get all access to that. So check out the link, come join. I made it purposely not expensive to really help, I think, the retail community. I do have institutional clients, but I think the retail community really doesn't have access to good macro research to understand things, and in particular complex topics like dynamics or options trading, they definitely don't have access to that. And so that's what I'm providing to people. I think it's been really interesting that I started it as kind of a hobby to just kind of stay on top of markets, but I found like enormous responses from people, just very good responses from people that they find it helpful. And if I've helped clients make money, that makes me just as happy if I've made money. So I love the responses I get back from people.
Absolutely. Great insights, Danny. Thank you so much.
Thank you. Have a good one.
You too.